ناقصتني، جبت المعدات وانطلقت. طبعا لأسرتي بنتي بالجامعة، طبعا بساعدها، بساعد أبنائي بالمدارس، ونفس الشيء جوزي. يعني جوزي ما بيشتغل، يعني كانت فترة من الزمن يعني إني عملته بالمساعدة. نطاق البيت لا، صرت أطمح خارج البيت، إنه يعني يصير عندي ريستورانت كبير، مطعم كبير، أعمل دورات مكثفة إلي، وبرضو أقدم دورات لطالبات، أمد إيدي للناس اللي محتاجة.
Women are in our part of the world need a lot of support, a lot of help, and they're amazing. So when they are given opportunities, they can achieve a lot for themselves and for their family, for their society, for their community. And they've proven that over and over again over the years. Overall, I think the biggest impact is a cultural impact of empowering women.
طبعا أنا يعني بحب إنه بيكون إلي استقلالية، بيكون إلي مثل رأس مال، إنه بعرف أشتغل فيه، بتحرك فيه في عائلتي. بعدين أنا عندي بنات يعني بيشتغلوا طالبات، يعني مثل بساعدهم. في ستات يعني مثل أرامل كمان بيشتغلوا معانا، ستات بيوت بدهم يحسنوا وضعهم. طبعا كتير انبسطنا بهذا القرض وكتير ساعدنا، وال200 اللي أخذتهم أنا بذاك الوقت يعني كانوا بيعملوا إشي، ساعدوني كتير. صرت إنه أبدي اشتري شوية مواد، لما بيجيني إنه مرابح بزيد إنه على المصاري اللي أخذتها من القرض، بدي أربي زباين، بدي إنه أثبت حالي بالمجتمع. تغيرت حياتي كتير. روحوا لا بيعرفوا إنه هذا القرض شو أخذناه. ست ما عندها خبرة بيأخذوها بدخلوها دورة مشان تعرف كيف تشتغل، كيف تتعامل، كيف إنه تبدي مشروعها، كيف إنه مثلا بتكون إنسانة منتجة مفيدة، بتفيد حالها كمان بنفس الوقت وبتفيد أسرتها.
Okay, great. I think we're live. Welcome everyone to this virtual plenary session on creating an environment for effective and inclusive savings. My name is Veselina Angelo. I'm with the World Savings and Retail Banking Institute, where I lead Scale to Save, a partnership savings-led initiative supported by the MasterCard Foundation in 6 countries in Africa. We have a very exclusive panel of experts here with us today. So let me introduce them to you. So I would like to give a very warm welcome to Beth Rhyne, who's the former managing director of the Center for Financial Inclusion. And she's also one of the co-founders of CGAP, the consultative group to assist the poor. We also have here with us today Luis Trevino Garza, who is a policy manager with the Alliance for Financial Inclusion. And I would also like to give a very warm welcome to Stuart Rutherford, who is the author of The Poor and Their Money. He's also the co-author of The Portfolios of the Poor, and he is currently with the Rishpara Daily's Diary project in Bangladesh. So a very warm welcome to all of you. As you can see, we have a plenary that brings together experts from different backgrounds. And I will ask Beth to be taking the view from the supply side perspective today. Stuart is going to share insights from a demand side perspective. And Luis obviously will then going to be holding the policymaker perspective. Our discussion will focus on how to ensure that the market environment is conducive to encouraging both access to and usage of savings. So first of all, let me introduce the order of the events and give you a few guidelines. I would like to remind all attendees that you are muted and your videos are off. We will kick off the discussion during a 10 minutes chat, and then we will engage the experts in a 25 minutes in-depth discussion before we get to the Q&A session that will take 15 minutes. So please feel free to use the chat box for questions, and it would be great if you could address the questions directly to the speakers. And you can do this throughout the conversation, and we will then pick up the questions during the Q&A session. So let's now kick off the chat with the first question that I want to ask to the three panelists, and I will ask them to respond from a customer, from a supply, and from a policymaker perspective, if possible. So the question is, what do we actually mean by effective and inclusive savings? And I would like to start with Beth, ladies first, to share with us what you think how suppliers understand effective and inclusive savings.
Thank you, Vasilina. I would like to just start by saying that savings is something that we all understand somewhat differently. It's interesting to know that across the world, the word for credit is the same in all languages, but the words for savings are very different. And when you ask people about savings, they sometimes don't exactly know what you're talking about. But I think from a supply side perspective, a lot of financial institutions regard savings as their cheap source of funds, and that is an interesting perspective because it suggests going after big savings, big chunks of savings that stay in the bank for a long time, and so I think you have to be a dedicated certain type of financial institution that has a dedication to the well-being of lower income customers to really want to go out and do inclusive and effective savings that supports lower income people.
Yes, great. So I think Beth has already given us some hints towards what customers might understand under effective and inclusive savings. But Stuart, what's your take on that?
Thank you. Yes, I think the question kind of implies that we think that poor people on the whole, most of them like to save, want to save, and I think that's true. So I'd like to kick us off with a bit of a discussion about the practical problems that they may face when they're trying to save. And to do that, I'd like to start with the observation that when a bank or an MFI offers a savings service, it's actually offering two services. It's offering to collect the savings, and it's offering to store the savings. And these two services are actually rather different. And the collection part is particularly important for poor people. People who are not poor generally, typically, see most of their income coming in via a bank. And that bank can siphon off bits of that income, put it into a savings account, put it into a pensions account, put it into an insurance account, and so on. So they don't, on the whole, have to worry too much about the collection side of it. They can focus on the storage side. They can worry about whether their store of savings, their savings balance, is performing well, is yielding well, is secure, and so forth. But for a lot of very poor people around the world, their income does not typically come in through a bank. So they do not have access to this kind of automated collection system. So they have to manage their collection of savings for themselves. They have to sort of scurry around and find somewhere to place a few pennies as safely as they can. And they have to remember to do it as often as possible and as much as possible. So they live in a world of what you might call do-it-yourself savings. Back in the 1990s, I wrote an essay which I called Saving is a Verb. And the point of that title was to say that for poor people, saving is something that you have to do before that it's something that you can have. And that doing is very hard for many poor people. So the message of that essay was that if you want to help poor people, start with saving as a verb. Start with a collection of savings. Let me give very briefly two quick examples. First of all, the well-known Susu collectors of West Africa. You probably know about them. They go around their clients each day, collecting a little bit of savings. And at the end of each month, they give the savings for that month back to the clients. Now, that's about as pure a collection service as you can imagine, isn't it? And it's very popular. And enormous amounts of savings are made in that way. Now, those Susu collectors focus on the collection side of things because they know that that's the really hard bit for poor people. It's also the reason why they're able to charge them to do it. And we can learn from them. And my second example is good old Grameen Bank of Bangladesh. When it started and Grameen Bank was only interested in microcredit, what it did was it focused very sharply and very successfully on finding ways to collect the small repayments to its loans. As a result, when eventually Grameen got round to realizing that savings are also very important to their clients, they already had a really good collection system in place. And as a result, within 3 years, their savings portfolio went from virtually zero to 1.5 times the size of their massive multi-million-dollar loan portfolio. So by being clever about helping people to do the act of making small pains, they soon got to a position where they were also able to store a large quantity of savings for their clients. So we can learn from them too. Thank you.
Great, excellent examples, Stuart. What I'm hearing is that obviously there's a lot of trust needed to store at the end of the day, but above all, people need safety in order to start collecting as well. So let's move to Luis and hear from a regulator perspective what regulators understand under inclusive and effective savings.
Well, thank you. Well, first of all, thank you for inviting us to this event on behalf of AFI. And well, I think, savings from the regulators' perspective, it's really crucial. And, thinking from the beginning of, especially on this conceptualization of financial inclusion, right, from the beginning, I think savings was the one of the priorities, even above credit, right? In the past, there has been quite a lot of interest in credit and financing, but I think with the financial inclusion conceptualization, the emphasis has been quite a lot towards enabling savings. And from a regulator and from a policymaker perspective, I think savings are an important factor that brings stability, right? Financial stability, right? In fact, to expand the credit, you need a savings base, right? It also is an important factor for resilience, no? Especially on the more vulnerable groups, right? And it's a factor of economic growth, right? It's an important factor of economic growth, I think. And we can link this also to this perspective on financial health that I think Beth can go and go much more in depth than me. But also on this financial needs perspective that we have been working on these different components of financial needs, right? The basic 4 financial needs are basically the transactional, right? That it's sometimes can be the door to financial inclusion, right? The remittances, the payments, I think they are very important, but they are not enough, right? But the liquidity, right? So you need and people, and also Stuart, I'm sure on the studies that he has developed, it's clear that savings is an important factor of enabling smooth the different financial flows and enable the liquidity and the resilience, right? It's the first source, additional to other sources, to enable when you have an economic shock, to enable individuals and businesses to really face those shocks. So I think basically, and also if we go to the and we go to the statistics, we go to what and now we have the global Findex and other resources. We see also that a very big gap, at a national level, but also at the household level between developing and developed countries and in terms of savings. And so I think that's I think policymakers, regulators are really interested on enabling this environment for savings, right? Also, I think if we go to the history, we can see that savings have been at the forefront. You can think of developed countries as Germany, right? That they really started their economic development was also, I think, the SACCOs, the credit unions. It's a really important factor of their development, and it was really through this savings infrastructure that these credit unions brought, right? So I think it's very clear the component. Let me stop here.
Yes, excellent. Well, thank you very much. And I heard you mentioning payments, and I've also heard people saying that payments are actually the immediate need of especially low-income people, and they would then start thinking about savings. So we should not forget that when thinking about the effectiveness and inclusiveness of savings. So great, we are now moving to the next section. So thank you for putting us all on the same page as far as the definition is concerned. And I would now like to dive into the conversation, and I'd like to start with the customer side, because we also want suppliers and maybe also regulators to start moving away from thinking products and channels and start thinking customers. So let's start with the customer side. And I believe that most of us who've started working in the field of financial inclusion in the early 2000s have been kind of growing up with the portfolios of the poor and the poor and their money. So as a reference for understanding financial behavior of the underserved and unbanked. So I'd like to ask Stuart, now almost 20 years later since the first diaries were published, Are your diaries telling you anything fresh about savings behavior of customers? Stuart, please. And if you could unmute yourself so that we can all hear you, that would be excellent. Thank you.
That's a good idea. Thank you. Yes. Yes, the answer to your question is yes, especially if I compare those diaries back in 1999-2000 with the diaries that I'm doing at the moment. All the diaries that I've ever done tend to show that poor people have a strong propensity to save. But if we look at the evidence from the diaries of 1999-2000, we see that desire to save was expressed very much in the way that I described in my introductory remarks. That is to say that most of the diarists in that diary set were in the position of doing do-it-yourself savings. They were having to run around looking for somewhere to save by themselves. Quite a few of them saved with relatives or with employers. Quite a lot of them saved at home, which is fine, but saving at home is not ideal for putting large flows of savings in or amassing large balances. Quite a few of them saved with savings clubs like Askers and Roskers, which are a kind of community-based version of do-it-yourself savings. And at that time, microcredit was already there in the lives of our diaries, because we're talking about Bangladesh. But the microfinance organizations had not got round to putting any focus on savings. So none of our diaries in that 1999-2000 set were receiving any institutional help to solve this very difficult problem of how you make savings. Now, if we fast forward to the diaries that I'm doing now, there's a tremendous difference. The diaries that I'm doing now are daily diaries. That means we take the data each day from our diarists, and we've been running them continually for more than 5 years now. So we've got millions of data points about how poor and very poor people actually manage their money. And what we're seeing is that because in the area where we are working in central Bangladesh, Grameen Bank has now had 2 decades experience of promoting savings, and because most of its competitors have followed suit, and because in that area also there are a number of smaller cooperatives that offer daily savings collection services, most of our diaries now do have access to a savings collection service that is reliable, regular, flexible, frequent, and close at hand. And those 5 attributes of savings collection services that I think are very important. As a result, their flows and their balances are growing steadily. Indeed, their savings balances are larger than their loan outstanding balances from MFIs, which certainly wasn't the case 20 years ago. And that's true for them as a group. It's also true for most of them as individuals. Another thing we've noticed is that over the time, the poorest diarists amongst them are showing a tendency to become less keen on borrowing and more keen on saving. Also, another thing we notice is that saving is not just a habit, it's also habit forming. That means that after people start to save, they tend to carry on doing it through rain and shine. And just one last thing I want to say about a new discovery for me from the current set of diaries that we are doing, and that concerns cash reserves held in the household. They are surprisingly large, at least they were large enough to surprise me. And they're very significant because, for example, they were instrumental in helping our diarists to survive during the coronavirus lockdowns that we experienced early in the year. Thank you.
Excellent. Thank you very much, Stuart. So what I'm hearing is that people indeed have access to more reliable, flexible, and frequent services. People do save more. However, there's still a lot of cash in the households.
Yes, and that situation which I described is a somewhat privileged situation for people in areas like Bangladesh, where MFIs have started taking savings in a meaningful way. In many other parts of the world, a lot of poor people are still stuck in that do-it-yourself style of savings that I described earlier on.
Right. So my question actually is, how do we get people to move that cash from the household tin box to a microfinance institution, deposit-taking microfinance institution, or a formal financial service provider? So I would like to hear from Beth, from the supply side. How can financial service providers incentivize active savings more, and especially amongst people who hardly can make ends meet? Beth, please.
Well, so I think there's a question that we need to look at that it's often completely ignored in the discussions about savings, and that is, does it make sense for customers to save in a financial institution or save in financial form? And the answer quite often is no, it doesn't. And I think that changes from country to country, but this is a big policy issue. Are we asking people to save in a situation where the inflation eats up whatever value they would have gotten? Is there confidence in the institution that they're saving in? And very importantly, are there alternatives, ways to keep the value of your money that are better than putting it in financial form? And so here we're talking not so much about the transactional sort of working capital piece of the savings that has to move in and out, which is, I think, mainly what Stuart has been referring to, but thinking about longer accumulation of savings. And I just want to give the example of Latin America, where because of the years of hyperinflation, people are very skeptical of putting their money in banks. And it hasn't been a good investment for many of them for many years. I think things have changed, but you still have attitudes about this. And the attitude that you hear most frequently is, I want my money to work, and I can't afford to have it sitting around where all it's doing is sitting there. And so I'd rather put it in building a room that I can use to rent later on. So anyway, I do think that we need to spend a little bit more time before just saying everybody should put their money in a bank, thinking about whether it's a good decision for people to put their money in a bank. But then when you're looking at how to incentivize, the big issue for financial institutions is how to incentivize them to want to collect the savings. And there, I think there's a set of policy issues to look at, as well as practical issues. I think one of the reasons why it's been so hard to have collections done the way that Stuart has been mentioning is the marginal cost is greater than the amount of value that's received. And so I'm hopeful that digitization, while digitization of an institution is expensive, it does drive down the marginal cost, and therefore, of collecting very small amounts of savings. And so it should change the balance somewhat in terms of a financial institution's incentive to collect savings. Maybe I'll just stop there, but there's lots more to say on this subject, but we can move forward.
Yes, great. And when you say digitization, obviously we could also talk about the feasibility and the benefits of partnerships right? So that not every institution does need to have their own agent network, for example, because from a customer perspective, it might not matter so much who is offering the service as long as it is a accessible doorstep service. I'm seeing here that we have not yet received any comments or questions, so please don't be shy. And I promise we'll be picking all or most of them up at the end of the session. So with that, I would like to throw the ball back to Stuart and understand whether in the diaries that we see today, there are new ways of designing, delivering, and promoting savings amongst low-income populations. Is there anything what financial service providers could do differently to attract low-income savers? What are your diaries telling us?
Yes, although it's I would like to limit my remarks to the diaries that I'm doing at the moment, which is for this particular group of diarists in central Bangladesh. And Bangladesh is not necessarily these days typical of a lot of developing countries. But one of the things that's coming clearly out of the diaries, all the diary work I've done in Bangladesh, is that if we want to allow our clients to have more choices and better access to the savings services that they choose to do. And I am very conscious of what Beth has just said, and I agree with everything she just said about let us not jump into the assumption that saving is always the best option. It isn't. It's only an option. I think one of the things I would ask the Bangladeshi MFIs is to stop smothering their clients with loans. After all, loans and savings are simply alternative versions of the same thing, alternative ways of moving money through time. Savings allows past income to be available for spending now, and loans allows future income to be available for spending now. And they both do it in exactly the same way. They both...
I'm sorry, Stuart, you just got muted.
Yep, okay.
Yes, all right.
Have I come off again now? Yes, good.
Yeah.
So the yeah. So where was I? So this whether you're saving or whether you're repaying loans, you're doing the same thing. You're subtracting small amounts from your income and setting it aside somewhere. And the poor can do this. The poor can do this, and the poor do this. But MFIs, naturally, for certain commercial reasons, tend to lead clients unequally towards borrowing rather than saving. And there are some things we can do about this. We can, for example, try and get MFIs to remove some bad practices. One example that comes out very clearly in the diaries is that there are still MFIs who tell their clients that unless they borrow from the MFI, they will close their savings accounts. And I'm afraid that we have 23 different MFIs serving the diarists in the current set of diaries I'm doing, and nearly all of those 23 are guilty of this. And so we have recorded through the diaries many examples where clients have taken MFI loans that they don't want and they don't need, simply to protect their access to the saving services. That clearly must stop. And that's clearly something that's within the power of the MFIs to stop, and they should do it. More fundamentally, I have some ideas about how we might improve things. I think that MFIs must be persuaded that when they lend, they must have mechanisms in place to make sure that their lending doesn't squeeze out the saving. And I think there are some interesting ways of doing this. One that I'm particularly interested in is what I call hybrid savings. These are products in which there are both savings and borrowing elements. And the result of this is that you can get to a situation that is highly productive and highly sustainable for low-income households, in which they are at the same time creating a growing stock of savings against which they can borrow more securely and with less stress and more cheaply than they otherwise might from the MFIs. And if anybody wants to hear more about these kinds of hybrid products, do please get in touch with me. Let me stop there.
Yeah, I would just say that, you know, over across the world in Latin America, Acción has experimented also with hybrid products, but maybe not the kind that you are describing. It's done some experiments with products in which the loan repayments, a portion of the loan repayment goes into a savings account, so that by the time the person has finished paying their loan back, they have a store of value that they can do something else with. I'm not sure how well those products ever caught on, but they were at least experimented with.
Yes, and they are an example of what I would call a hybrid product, yes.
Right, so something to absolutely keep in mind, hybrid products. I wonder whether this then also applies to micro-insurance, micro-savings bundles that could make savings more attractive. You're shaking your head, Stuart. Well, maybe that's for another discussion then.
Yes.
So I would like to move to the regulator side and ask Luis, what can regulators do to incentivize financial service providers to provide more effective and inclusive savings?
Thank you. I think it's very, very interesting, the conversation, and I think, you know, as mentioned, I think there's an increasing interest from regulators on promoting the savings, right? Especially because, and you know, looking at also, you know, there's an important, for instance, looking at savings in informal mechanism. There's you know, a really disparity between men and women. So, you know, and you can ask in different countries. You can see that. You know, you can see sometimes you look at the statistics and you see that financially men and women are kind of the same, right? And but looking at how they are using finance, especially on savings and so forth, you know, women usually go more into you know, informal mechanisms and sometimes through BSLAs, through even Roscas or the savings groups. So I think from, you know, there's an increasing interest to find mechanisms to lower, as mentioned by Beth, the transactional costs, because also, you know, we need to, you know, savings are costly, especially if you think of a traditional bank, a traditional institution that has a very complex infrastructure. You know, small savings is not within their business model, right? So we can see that there's right now a very huge opportunity in digital savings, right? On all of this, and for instance, thinking about the current context on COVID-19, where, you know, many of the policies that have been implemented to enable digital financial services and different ways to enable not transactions, but also you know, the savings have been, in many countries, have been fast-tracked, right? So I think right now we are also looking at this like it's an opportunity, right? This is also not without any costs, right? Also regulatory costs, because with this, you, as a regulator, you need to be sure that the this innovate. For instance, if you have an innovative channel, a fintech that provides that is e-wallets that provide not only transactional accounts but also savings, you need to, as a regulator, to protect the float, right? Make sure that the float is protected. You need to also be aware of and the secure side, have the address any issue of cybersecurity. And then also there's another issue from the demand side on digital literacy, right? So there's also a pathway, especially in low income or on vulnerable groups, where the transitions towards digital mechanisms needs first to entrust and also to learn, and have confidence on usage of these digital mechanisms. But I think definitely there's a lot of opportunities there, right? And so in this context, thinking of this context of COVID, and I'm bringing this because also I think it's an important issue that we all are thinking of. These are these measures that in many countries started some months ago, and that have been fast-tracked. For instance, some fees has been lowered to enable digital means of transactions, but also of enabling allow people to take stock of balances, right? Of an increasing amount of balances to cope with the emergency. I think this is also brings all of these other policies that have to be implemented, right? Now, also thinking on savings from the regulator, from the policymaker perspective, I think also an important element is to have this first the interest from the regulator, the awareness that this is an important issue, right? Speaking of this gender imbalance, I think in many countries, and we have been working with 2 case studies where there are there is an increased interest on enabling, for instance, digitizing saving groups, especially to targeting more financial inclusion of women and more savings from women, right? And I can mention 2 countries that are working right now on this. One is Egypt, another one is Zambia. Now they have been working and at the central bank level, at the leadership level, they have been working quite a lot on this. They have also, additional to the leadership and to have this, it's important the collaboration. So also regulators need to be aware that they need to bring together different stakeholders, for instance, NGOs that are endorsing savings with financial service providers and facilitating, for instance, because also all of this transforming, for instance, savings groups into a digital environment implies quite a lot of investment from a financial service provider perspective, right? They need to pilot this before they need to test before even think about launching a product, right? So I think the relevance of having this leadership and this back from the regulator, it's really important and can lead a transformation, right, in the ecosystem, right, on financial ecosystem. I don't know.
Great. Yes. Well, thank you. Thank you very much, Luis. You've raised quite a number of points. So let's see if we can address all of them with the remaining time and to still be able to answer some questions and comments that are coming in. So what I heard is that regulators have started to easing measures to also allow the informal and low-income people that are saving in groups to be able to use formal financial services in some way. So I believe this is a great thing. You've also mentioned partnerships that are key in making finance work for the underserved and unbanked. And you've also mentioned more recent measures that regulators have been taken linked to the current pandemic. So let's perhaps shift to the more current situation and how customers and financial service providers reacted to the pandemic. And with that, I would like to ask Beth what the pandemic has shown us about savings, the savings capacity of low-income people, and perhaps Stuart, you can also chip in here. So savings capacity of low-income people during the pandemic, and how did financial service providers react? Beth, if you want to start.
Yeah, so I think there was a big concern early on in the pandemic that by financial institutions that they were going to see mass withdrawals as people lost income and therefore started depending on their savings. And to my knowledge, that didn't turn out to be the case. There were some withdrawals, perhaps a bit more than usual, but there wasn't a real mass taking your money out. And so I definitely want to hear what Stuart you have to say about that. But what I observed was this very interesting phenomenon. I was looking at the resilience question. So people were asked, people have been asked for many years now, this question about how long your resources will hold out. So they say, the researcher says, if you lost your income, how long would you be able to manage on your current resources? And people have very, very short times that they say. The majority of the people in many countries are saying things that are saying that they would be able to last for less than a month. So we start going into the pandemic with this kind of statement. Then 3 months into the pandemic, you ask people the same question and they give you the same answer. And so it's, rather than having completely depleted all of their resources, they still feel like they have a couple of weeks of resources at hand that they can draw on. And it's a mystery to me what that is telling us. It may be telling us that asking this question isn't a very good question, but I think it's also telling us something about the way people manage and handle their savings during the downtimes.
Yes, can I come in there, Wesley?
Yes,
because
absolutely.
I think Beth's right. Beth is right, and I would like to just sort of give a specific example taken from the Trishipara diaries, because of course we've been looking extremely closely at our diaries during the pandemic period. There was no great sucking noise as people drew out their savings, but partly that was because of the lockdown, the MFIs were closed. So the MFIs weren't in a position to give the savings back anyway. So in one sense, the main reason why people didn't, I should explain that in Bangladesh, most poor people keep the bulk of their formal savings in MFIs rather than any other institution. And those MFIs were closed and were unable to release those savings during the period of the lockdown, which went on for about a couple of months in Bangladesh. Now, what's interesting about that is, number one, as I said before, it turned out people had surprisingly large amounts of cash stored at home. And there's some evidence from the diaries that they actually built up that store of cash at home ahead of the lockdown. In other words, after they'd heard and got scared about Corona, but before the lockdown actually started. And then what they did during the lockdown is they simply tightened their belts. They simply stopped spending on anything else except essentials. So if we look, for example, in the diaries at spending on clothes, through the whole of April and the first half of May, it was zero. No one, and in none of our diaries, spent a penny on clothes, but their food expenditure kept more or less the same as it usually is. Now, another interesting thing is that when we understood that the MFIs were unable to return savings to clients who may want to take it, and when we, as we well know, that most of our diaries keep most of their formal savings in MFIs, obviously we asked our diaries, what do you think about this? And interestingly, they weren't that worried. It wasn't like they were hanging around outside, storming the MFIs and saying, give me my savings back. They weren't doing that. On the contrary, they were, the typical response was, okay, that's fine. Let me keep my savings there. You never know, things may even get worse. So people took a very conservative attitude towards conserving their savings. They looked to get themselves through the current crisis by using the cash reserves in their home and by simply tightening their belts and not spending on anything except essentials. And in that way, they made it all the way through. I should explain that about a quarter of our diarists would be extreme poor, using the World Bank definition of earning less than $2 per person per day. And even amongst that extreme poor group of our diarists, we did not find reports of people going hungry. We did not find reports of people missing a lot of meals. They cut down, but they kept eating. So I think the overall picture is that, this word resilience that we keep hearing, we have in the diaries a documented example of the extreme resilience of poor people when faced with emergencies of this sort.
Mm-hmm. Yeah, great. I think it's very important and useful to know that low-income people do keep their savings in times of shock. So the question again is, how can we, as financial service providers or regulators, create a more meaningful, inclusive offer for these people who do keep their savings at home? And I would like to open up the Q&A session now, because we have a few questions coming in. And there are a couple of questions linked to the hybrid solutions and how they could work as a mechanism. So first of all, there is a comment suggesting that in Tunisia, savings collections from MFIs are still kind of a taboo. The authorities are considering moving forward with a hybrid solution where some microfinance institutions serve as an intermediate collector in the name of a bank, meaning that the MFI clients' savings are collected by the MFI, but then stored with the formal financial service provider. So the question is, what do you think of that mechanism? Do you think this is a workable solution, and how can it be made effective and inclusive? Who wants to take that?
Well, I'll just say one thing, which is I think the incentives, those incentives don't work very well, because you have the people doing the collections don't have any they don't have any benefit from doing the collections, and they don't have any interest. And I think if you look at the history of microfinance over time, the drive to be qualified to be able to take savings has been a huge driver in the shift from a bunch of NGOs, the way that microfinance started out, to a bunch of regulated financial institutions. And so the idea of sort of keeping them locked up as adjuncts to real financial institution, I think, is self-defeating.
Wait, Stuart, would you want to add something to that?
No, I basically agree with Beth on that. It's perfectly true that some MFIs that might be highly motivated to serve their clients, even if they're not making much money out of it, might be inclined to go down that route. But as Beth says, I think they would be in a minority. So I don't think this is a kind of a general solution, although it is happening in some countries. I believe not just in, was it Tunisia that the question came from?
Yeah.
I hear it being discussed in India at the moment, because India is a case where the regulations provide that most of the MFIs are only allowed to lend and not allowed to collect savings. So there is some discussion going on within India about how to get around that, and it does include the discussion of this mechanism that this commentator mentions.
I would just say also it's a really live question now for digital lenders and what will happen to them.
Absolutely. So there was another question on hybridity, which I cannot find now. So I have one for Luis. First of all, thank you for the very interesting discussion. Casual empiricism suggests that strict regulation and monitoring bank accounts, ownership, and transactions, such as KYC, serves as a key barrier to entry for the poor. What is your reaction to that?
Thank you. Yes, yes, KYC, it's a factor that increments, right, the cost. But I think, especially thinking about digital financial services and these more flexible approaches on enabling digital identities, and eKYC frameworks, I think this may lower the cost, right? And especially on this, KYC, it's always, it can be a burden, especially, and it means quite a lot of initial investment, right, in terms of also strengthening out the identification systems, right? So this is an important factor. But I think once implemented this, I think it paves the way to really enabling a more, especially using eKYC systems, an element of enabling digital savings more easily, right? Also, I think the role of regulators is very important. And as I mentioned, I have, for instance, the case of in Ghana, right, where they established for instance, the e-wallet, right, and the central bank started to ensure the float was protected, right, because it's like one of the first conditions, right, because always as a regulator you need to see also the side that they need to really endorse or make sure that the deposit taking, right, the funds is appropriately backed, right, by the fund, and that's one condition. But also for instance, in the case of Bank of Ghana, they additional to to back the float, right, on e-wallets and backing them by banks. They also negotiate with banks to enable some small interest, right, for very small interest, but at least an interest that returns to the e-wallet account holders. That I think it's something, and it's something that can also have an important element, right, in eventually enabling the savings culture and especially on these digital financial services. So I think the role of regulators is really crucial, right? First, enabling this more flexible approach, right, that need to be adapted, right, to the digital platforms. Also enabling more, the more players, right, in one hand, and in the other hand, also ensuring that these new players are, they comply with the requirements on security issues, on data privacy, all that are really important, right? Because you don't want to include, especially on the vulnerable groups, financial include and with financial services or financial products that will be harmful. So I know sometimes maybe the cost, especially the regulatory cost, might be substantial at the beginning, but I think at the end it will pave the way to enable, right, this I think this ecosystem.
Right, and I believe one of the things that we have seen more recently linked to the crisis is that regulators have actually reacted quite in favor of less KYC and lifting fees, digital fees, to make it easier for especially low-income people to access services. And one of the questions going forward will be how do we continue easing access to savings, whether formal or informal, to make it safe, effective, and inclusive for low-income people. We are at the end of our session. I would very much like to thank you to this panel for being so disciplined in keeping the times, for providing great insights, and also to the participants for asking great questions. Before we close, I would like to do a little self-promotion. So there will be another session tomorrow on the role of supporting organizations in encouraging effective and inclusive savings. There you will have the opportunity to hear from 3 initiatives: Scale to Save, Savings at the Frontiers, and the German Savings Banks Foundation, savings-led initiatives across the globe. But for now, I would like to thank again everyone, and please do not forget to connect to the European Microfinance Week's award ceremony that is taking place subsequent to this session. So thank you very much again, and hope to see you soon. Thank you, Beth. Thank you, Stuart. Thank you, Luis.
Thank you very much.
Thank you, Vasilina.
Thank you. Really a pleasure.
Yes.
Really a pleasure.
Thank you.